All right, welcome to the Sherman Show. I am Jeff Sherman, and I'm here with my co-host Sam Lau.
Hey.
And we are coming once again from the YouTube channel, so you can catch us in video if you'd like to, or if you use our preferred method, just go to your podcast app and you can listen to us instead of having to look at us. But today we have a pretty special guest coming from across the water, and it's not across the pond, it's actually across the Pacific Ocean. We have Elizabeth Burton, who is the Chief Investment Officer of the Employees Retirement System of the state of Hawaii. Welcome, Elizabeth.
Thank you, Jeff. Nice to be here.
Yeah, so I think the acronym is HIERS, H-I-E-R-S. There's always the ERSs when we get into the pension system here, but see approximately $21 billion in assets. You're also on the board of directors of the CAIA, the Chartered Alternative Investment Association. You've received many accolades in your short career, where you've gotten the CIO magazine's top 40 under 40. You've had many industry innovation awards, and I also see you're up for another award for promoting your team significantly. So it sounds like you've achieved a lot of accolades, but more importantly, you stress the part of the team. So tell me about your role as a CIO and how you emphasize kind of that team spirit in leading your investment staff.
Yeah, sure. I think that's the award I'm most excited about, but it's also pretty competitive. There's other people out there who support their team, including my former boss. But, I think my situation was a little bit unique. You mentioned 40 under 40. That was a couple of years ago. I'm still under 40, but which I hate being anchored to. Let's just move that down the pike. But I think when I came here, I was significantly younger than a lot of folks on my team, and didn't maybe have as many years of experience in the markets, right? So I think one of the benefits of supporting the team is that they've had decades more of experience than me, and they've seen firsthand a lot of different market cycles. I mean, I was around in 2008. I was actually trading mortgages back then, but that's pretty much until recently the biggest shift in the markets I had seen. So supporting my team is pretty easy. I've said this before, and I like to joke that I only got into football about 10 years ago, and I know more about it than my husband does now. But he actually was watching Lawrence Taylor, where I can only see the replays and hear about it. And so it's always great to have the benefit of experience of people who were there in the weeds, who actually knew what it felt like, especially now that we've got these more frequent major market moves than we had in the past.
Yeah, well, if you want to see it, unfortunately, the beginning of the movie, The Blind Side, the book by Michael Lewis too. Yeah. There is the intro of Lawrence Taylor in there, and he just he crushes my San Francisco quarterback. So that was a pretty ugly intro to the movie. But let's talk a little bit about a pension system too for our listeners that don't know a lot about it. So what is your objective as being a CIO and an allocator at a pension plan? How does it work, and what are you trying to achieve for your end clients?
I mean, I think the short answer is my objective is to achieve our target return within the given level of risk the board sets out, which would be 7% target return. I think there's a myriad of other responsibilities that are maybe not written into my contract, but are there. For example, trying to make sure that we're looking at investments in Hawaii, trying to make sure that we're investing responsibly, trying to educate the public and retirees on what we're investing in. But at the end of the day, the number one thing I have to do is protect retirement benefits of the people who paid into the system or didn't pay into the system, depending on the year, but that are counting on this in the future. And I was speaking to someone today. I think that all sounds nice, but it's getting more challenging because and I don't want to bring up inflation in the first 9 minutes here, but if we think about the possibility of high inflation, that job becomes more challenging on the liability side. And a lot of us have only been focused on the asset side for the last couple of decades because of where the market has gone. So it's becoming an increasingly difficult job.
Yeah. So you mentioned the liability component. And so, ultimately what you're trying to do is pay retirees, right? They pay the system, you're investing their money for them so that they can have this stream of income later in life. You said you have a 7% return objective, but then you bring in this word inflation. Why do you care about inflation if your job is just to make a 7% return?
Well, it's funny because some pension funds actually do produce. I think Florida and Maryland actually have real target returns. So we care about the real targets, right? Because what good is that money that they're receiving if it's not going to be able to purchase the same amount of goods and services? But for me, if you look at forward-looking expectations and assume just we have a 60-40 portfolio, it'll be hard to get a 7% rate, but it's really hard to get that when real returns are negative. So we care about for that reason for one, but second of all, some pension funds liabilities are matched to inflation, so they'll increase the higher that becomes. So then you're getting hurt on both sides of the coin. Because I like to think about it like a balance. One side we have the assets, one side we have liabilities. I'm supposed to be in charge of this, but I have to the asset side, but I have to watch what's happening on the liabilities because it increases our cost of capital or discount rate, what have you.
Yeah. So as you think about that and how it's morphed too, what are you guys doing when thinking about the liability side? We've seen a big prevalence over the last decade or so of, a lot of the pension system go to liability driven investing. That is, they're trying to match the cash flows or the ultimate liability of the plan. And we've seen them go into fixed income assets, very long duration nature assets, which, as you say, today don't really cut the mustard when it comes to inflation, right? We have the long bond trading at roughly 2% today, a little inside of that, which is not keeping pace with inflation. So how do you update your thinking? And when you're looking at kind of the universe, we've heard a lot of prevalence of going to private markets and trying to capture illiquidity. So you mentioned the 60-40 portfolio. How do you think about asset allocation in the overall context, understanding, where we are in the inflation regime, as well as just, valuation multiples in general? So that's your long-winded answer.
Yeah, I'll answer it in two parts. On the liability side, a lot of that I have to leave up to the legislature and the board and their decisions on contribution rates and whatnot. I could kill it for 10 years in a row and have a hard time making that balance work. It has to come from both sides, right? In terms of the portfolio allocation, yeah, I don't know that anyone's really 60-40 anymore. And I think the challenge is the closer you are to 60-40, if you are, the harder it's going to be to make those returns. And I didn't coin this phrase, but someone was saying, if you're on either side of that, all stocks or all bonds, you're also in a difficult position. So what do you do? So I've thought about this a lot in my portfolio. And I also realized that even though I've been talking about inflation for a year and a half, and now people are saying it's here, not everybody obviously agrees whether it's transitory or not. And they can't even agree on what transitory means. So do you reorient your entire portfolio around this? And here's the problem. So public pension funds run asset liability studies every couple of years, 3 to 5 years. Some do it sooner. But that inflation component is a key input into asset prices and into our asset liability models and into our CMAs, our capital market assumptions. So let's say that something shocking does happen in the next 18 to 24 months. We want to be sitting here and say, well, in 3 to 5 years, when we rerun the numbers, we'll see where that turns up for us, right? So we've got to have stuff in the portfolio now that we can sort of adjust, or at least gives us a hope in other environments. Because if you think about it, if you break the world down or the US markets, because we care a lot about US growth risk, into regimes, like 3 of the 4 regimes out there that we tend to pay most attention to are not great environments for pension funds. The one that was the one we just had the last, 15, 20 years. So what I'm trying to figure out.
So define those, just so our listeners know. Are you thinking about the balance of growth and inflation, or how do you define those regimes?
I mean, and you can just think about it as a quadrant, and this isn't unique to me, right? I'll steal it from Ray Dalio, but rising growth, falling growth, rising inflation, falling inflation. And we've been having growth plus falling inflation. So great. But now where are we headed? And I think obviously there's not complete consensus on what that means and over what time frame. And the time frame part is important, right? Because maybe you can do 60-40 if your time frame is 150 years or your time frame is 30 years. But even 10 years or 5 years of not hitting real returns and not hitting your target is devastating for a pension. That's a long time. And there have been decades like that, right? There have been tons of 10-year periods, which were challenging. For some reason, we were just all forgetting it. So on our portfolio, what can we do? We're rethinking real assets. You can do things at the margin in the liquid assets like risk premia and moving things around. You can think about active versus passive. You can think about value versus growth and whatnot. But I think the important thing for us is we can't take a bet on either side. It's just not my job to call the market. So that's more your job. But I want to make sure that we're doing enough that we have some protection, even down to looking at hedges and whatnot, and seeing what we can do there.
Yeah, so I'm kind of disappointed. I thought our macro guys came up with that quadrant themselves, so I'm gonna have to revisit that conversation with them. But you mentioned about not being conventional, and we hear a lot about not bucking convention. You interject what's called career risk, right? Where it's pretty easy to be the status quo. And Sam was doing some research on the system. And he noticed that, you don't have these conventional buckets, right? Where it's large cap growth, large cap value. Let's call them the style boxes. And then just, bonds and stocks. But you approach it a little differently. And I thought it was interesting because it was called growth, like broad-based growth, right? Which is on the topic we're talking about. And then also diversifying strategies. So usually when someone leads with the phrase diversification, that means the returns stink. Right. But hey, potentially they work in some environment. Sam used to joke that's how we sell commodities, right? They were a tough area, right? But they're diversifiers because they go down when everything else is going up. So thinking and putting on that framework, how do you bucket ideas into this growth? And then what do you mean by diversifying? You mentioned this risk premia concept. So how does that look?
Yeah. A lot of this was a hard adjustment for me because these buckets were here before I got here, and it took a long time for me to wrap my head around what they meant. I think the origin of it was in 2008, when the all correlations went to one and all buckets started drawing down. The labels that were associated with that, like why is our principal protection and fixed income bucket drawing down with our equity bucket? It was hard for people to not necessarily investment staff, but stakeholders, public, to figure out what was kind of happening. So we said, okay, rather than have these buckets that you think you've known historically what they're going to do, now we'll categorize them by their risk drivers, which I think the growth bucket is basically everything that's driven by U.S. growth risk, right? I mean, it doesn't say U.S., but that's what we care about here, right? So it is hard because if you ask me how many dollars do we have in emerging market equities, we actually don't think about it that way. We probably think about it in risk budgeting or beta terms. It's good and bad. It gets you away from some of the headline risks. So if you look at our portfolio, for example, there's short-term trend followers, STFs, which other people call CTAs. But there's a lot of news running around about CTAs. There's not a lot of news running about STFs. So you get less caught up in the mania of the moment and what are these bad things in there. And you focus more on what they're supposed to be doing in the portfolio. So diversifying is an interesting question. What is diversifying? And I agree with you. Like 6 or 7 years ago, in a prior life, I said, well, cash is diversifying, right? To where we were at the time. So I agree with you. It can be tricky. And I don't understand how you make money over the long run without equities. I don't hate equities. I've never hated equities. I've never hated beta, right? I think you need it. I don't understand how you do anything without it. It needs to be in your portfolio. But in this case, diversifying is really interesting because it can really be anything that's not, heavily weighted toward this U.S. growth risk. And I get your maybe tongue-in-cheek comment about maybe, I think you were trying to say some of that probably is beta. It's just got a lag to it. So it's hidden beta in some respects. And maybe that's true in certain cases. But the important part for us is that as the growth side of the portfolio keeps growing, it becomes a denominator issue for us. We need to rebalance. So we need to rebalance into something else that's not putting 100% of our eggs in one basket. So it can be, that was a long way of saying it could be a number of different things. And the career risk point, if I can get to you on that too, sure. I mean, that is a major issue. I think a lot of CIOs on this side face how big of a change do we want to make. But if you stick with 60-40 or plain vanilla portfolio for the next 10 years, you may not get fired, but I don't know how much good you're going to do. for the people you're trying to represent. So I think if you take this job, you have to be comfortable with a fair amount of career risk if you want to be any good at it.
Yeah, no, I think that's good. I mean, you talked about being responsible, and that's the responsibility that one owns there too. And so, if you're thinking about where you put these eggs in these baskets, so what happens from the standpoint of like public versus private? Because I hear so much that the institutional world is going private, right? There's less less equities out there in the world today. That there's just, they can't get it with the valuation where it's at on the public market. So they go to private, which I always scratch my head about that and say, well, isn't the heuristic just to value private off of public as well? So what are you thinking about the private buckets today? Are they larger than where you were, let's say, a couple of years ago? Or do you think about it differently? Are these truly in diversifying the bucket, or is this really just, as you said, it's more lag beta and mark to whenever we want to mark it instead? So
I think there's a place for public and private all over the place. I think, yes, I hear your point on equities, although there are parts of the globe where there's still alpha, right, in public equities. I don't know, some of them may be politically challenging to get access to, but no, I think that's fine. And I think, and then we could go down the passive active route there too. But on the private side, I think it depends on your system. How much illiquidity can you take? I think private assets are great for a number of reasons. Somewhat sarcastically, they're also great because you can't react that quickly to them. So you kind of have to grin and bear it. And I think that's great. I try to do that on my personal portfolio. Just don't look. I think we have grown. But a lot of that, like I mentioned earlier, was part of the asset allocation study from a couple of years ago, where we increased our target in private equity, for example, from 6 to 13. On the credit side, it's been much slower. I am much better on the credit side than I am on the equity side, and that's been something that we've been focusing on here, and that's gotten larger. It's still underweight, but I think there's. And realizing where you work, I think it's a challenging story for us sometimes on the very liquid side of some of these markets, and the search for yield sometimes takes us in a different direction. Even if it is somewhat of a smoothing and lagged effect, but I think like to be able to hold on to that capital and kind of wade through it is a good thing. On the private equity side, I have gotten a lot of questions lately. Are you thinking of increasing your allocation? And my answer would be no. I mean, I don't want to like call a bubble here, but if you look at the definition of a bubble, there's a lot of signals there that might be happening at some point. And it's getting harder and harder to reach our allocations, and you're seeing massive funds coming out. And so I think that I'm comfortable with where we are on the private equity side of the equation. On the credit side, I think there's a lot of really interesting stuff in specialty finance and esoteric ABS and stuff out there that we still don't have access to, that we could get access to. So it's really just the opportunity cost. And from a liquidity standpoint, I think we're more liquid than we really have to be right now. But I can't speak for all peers. Everyone's in a different position.
Yeah, well, I won't speak to the esoteric ABS stuff, but if you need someone, we may have some people that can find assets there. So anyway, forget the sales pitch. Sam was going to ask something, so go ahead, Sam.
Yeah, I was going to bring it on to this, the idea of the return bogey or the return targets that are in place for your system as well as others, and just thinking about the idea of balancing the needs of benefit obligations and with the amount that's being contributed and the amount that you could potentially return from your team there. But I guess my question is, how much input do you and your team have in that target return? We're talking about how it's becoming a little bit more difficult in the current market environment, based on some of the valuations and also just expected returns across asset classes. But oftentimes it's about managing expectations about what can be returned, given the current market versus what's required based on what your liabilities are. So, ultimately, how much input do you have into that? Because you are the one that is, tasked with achieving that return. Or is it just given to you and said, you got to do it?
This is
That
such a sensitive question. Let me try to navigate this as deftly as possible. I have an opinion and I have an input for sure. I get asked how I feel about it. I was asked when I joined how I felt about it. I think it is hard to make a 7. I also think it's hard to make a 6. We also have high contribution rates. Some of our beneficiaries are in 40% plus brackets, right? It's pretty high. And that basically just started. So we are seeing the benefits of that paying out. I think if you were considering changing that target rate, you wouldn't be able to immediately see the benefit of these sacrifices that are being made on the contribution side. So that's one part of it. The other part of it, and this is like a little bit hypocritical because I do think it's hard to add 10 basis points to the fund. I think that's super challenging. But it's very difficult for me to say the magnitude of the difficulty in achieving 6 versus 7, or you know what I'm saying in this environment. So
they both seem very difficult, irrespective of what number you choose, right?
They both seem very difficult. Yes. So the other thing is, we did just basically get 4 years of 7% in 1 year right now, which one might think you would breathe a sigh of relief. It is smoothed over a 25-year period on the actuarial side, so it's not that big of a change. But that could change, very dramatically the next year. Who knows? And in fact, it will probably be worse, right? Because we just pulled all this forward. So I don't know if I'm answering your question at all, but I guess I would say I don't really want to change the target return. I think I'm going to do my best to shoot for that. And, even if it was lower, I'd probably still try to shoot for more than that. So I think I'm being very vague, but that's where I'm going to go with.
All right. Well, you said you're going to navigate it. So let's portray this a different way. Instead of focusing on returns, let's focus on the other side of the equation, which is risk, right? So
Yeah.
how do you think about risk in the framework of the pension system, right? So you have your retirees. Obviously, the biggest risk is that they don't they don't get their paychecks, right? So how do you think about risk in your framework when you're putting this stuff together? Is it traditional like Markowitz mean variance optimization? Do you think about drawdowns? Like what are you trying to do from a risk management standpoint when putting all this together?
Yeah, we may have talked about this, but I hate mean variance optimization. I think it's I think it's ridiculous, right? Like there's so many assumptions put into those inputs. It's fun. It's really fun to play with and see what you could do with the portfolio and target, but it's almost meaningless because you're lying about a lot of the standard deviations and correlations. And now if
you just add 1% of Bitcoin on the back test, it looks really good that you should add a lot to your portfolio, right? So I think that's kind of where you're going with all this too, right?
Exactly.
It's all assumption driven. And what I like to tell people is the optimizer gives you what would have been the best portfolio over that period.
Oh, it's very true. But also a lot of those MBOs are running up I get that it's a little bit more complicated and the look back is weighted, but the last 20 years of correlation data is not the last 120 years of correlation data. So I'm really curious to see how people are using MBO. You can shock it and change how all those things work together, but we'll see. So no, that is not how we manage risk. It's not mean variance optimization. And I guess like a little bit, I prefer like appraisal ratio, but we don't really even use that either. But I think that's a good bellwether for what you're kind of expecting to happen. Like the number one thing for me is liquidity risk and then inefficiencies. So having been on the portfolio management side for not that long, but not as long as you potentially, but over the course of my career, I've seen a lot of places where on the institutional side, we're investing on one side and buying it on the other, or selling from one side and going to the other. And that happens in our PE book, right? But it happens throughout the fund. And I think part of the reason that happens is you've got 7 different buckets and they're investing in different things without a top-down view. And so one thing that we're really focused on here is being super efficient and not taking bets in one place and offsetting them in the other. And I can't take a lot of credit for that. That's a lot of Howard Hodel. He's much smarter than me. He's my chief risk officer and he's taught me a lot. But that's something that we manage very carefully. We manage our fees. We just have to be very razor thin on that because that's a source of alpha too, if we can get there. And then there's a ton of other things that we have to look at, like factor exposures in the portfolio, and underlying risks there. But for me, you hit the nail on the head. Liquidity, paying out benefits, like that's literally what we're supposed to be doing. So we have to be very careful about that. So managing what our true liquidity is critical. I absolutely hate it when people tell me I can liquidate my portfolio in 3 days. I'm like, that's nice. When did you ever liquidate your portfolio in 3 days and it turned out well and how you wanted? No one ever does that. It's just such a ridiculous statement.
Well, that's the new 22E4 rule that the SEC imposed to define liquidity. So we just got a little wonky there on that too for mutual funds. But yeah, no, it's exactly. I mean, it never goes well. It's like when we get a new client in too, and some of our guys want to like make duration match the first day. I'm like, really? We're have a long-term client here, really? And so we're going to worry about 1 days of performance. Like the idea is to do it, size in, and really execute thoroughly. So speaking of execution, let's transition to last year. So I actually, I think that was my last business meeting was actually of last year was actually with you prior to the pandemic. I
remember what you said too. You're like, the only way this becomes a bad thing for the economy is if no one goes out and buys anything or goes anywhere. And then like the next week.
It was gratuitous. It was a week. We were all gathered in a conference room or at a convention center, on in Oahu, and talking about this. Oh, this is going to pass. This is going to pass. How foolish we were. But how do you manage through an event like 2020? So, like thinking about it, were you able to move things around? You talked about how swift markets move these days. I mean, with the benefit of hindsight, I mean, it was like, it was a 30% drawdown, then it just bounced back with the Fed to the rescue. So were you able to make moves in that type of environment? Was the portfolio set up right? Did it behave? And also, what did you learn from 2020 from that perspective?
Yeah, so we had, well, I can't say we, but because I've only been here 3+ years, but the team had embarked on this post-date kind of trajectory where the next time a crisis happened, they would have these triggers in place to rebalance the portfolio. And that's essentially what happened. What I will say is, even with the triggers, it didn't turn out kind of how we were thinking, right? And yes, I said these episodes are getting shorter, but even when you're in the moment, you don't know that that's the case, right? Like, so I'm thinking back to like end of February, March. We have an overlay, a 60/40 overlay on top of the portfolio for cash management, essentially. And I think in March we flipped the 60/40, and it ended up being the wrong call, right? But if you looked out through June, but at the time you're sitting there, like you just don't know how bad this is going to get. And I remember thinking too, like this will be over by September. Whoops! I mean, it's still not over to September a year later. So I think the good news is on our liquid side, we did rebalance, and that helped us. We actually may have rebalanced too much, but we're working on kind of some of those studies now. But it did help our funds that had temporary drawdowns, providing them with capital. This time we also did like pretty quickly, I want to say in 3 days, add to 2 new TALF type funds, which didn't end up, as you know, really doing much. But
did you even get any money invested?
No.
We passed on those. We just there's no way this stuff works, and but again, that was just a hunch from our perspective too. But
yeah, I mean, but the good news is that we were able to deploy to do it, and so if something does come up, we know that we have the rails there to get all that done. So, did the portfolio behave as expected? Yes, almost to a T, exactly how we expected it I guess how the team expected it to perform. But it depends on what time period you look at. So I had always said part of my criticism of some of the strategies was this is going to draw down immediately. You don't think it will because when you run the analysis on it, you're looking over a 6-month time frame. But do you need your cash over 6 months, or did you need it right then? You need it right then. So yes and no, we were both right. Like it drew down immediately and then rebounded. So it depends what your needs are. I guess what we learned is we didn't need that cash right then. But in the flight to quality argument, that all kind of fell apart back then. So it did perform, but it just always depends on what time frame you look at. And we only drew down about 8.5%. Peers drew down much more than that. But we all catch up at year end. So it just depends on what it was important to you. So to us, it was protecting capital. To peers, it's making more money on the growth side of it, potentially. I don't know, but So I think what we learned, we spent a lot of more time looking at our rebalancing strategies. I think we learned some lessons about private credit, probably for the better. And we learned, about some new strategies that and how they might perform.
What was the lesson learned? Can you share that with us?
Well, we actually didn't have a ton in private credit, I think, versus peers on average. And we've been, one of the things that I had kept hearing was, well, we don't know how it performs. We don't know how it performs. Don't know how it performs. Well, it did fine, right? So it made it through its first, on balance, like it made it through its first kind of hiccup there. And on the PE side, which seemed to be a little bit brutal in the beginning, it made it through that in spades as well. So a lot of the stuff we didn't have a ton of access to, we kind of got to see how that played out. And, on a selfish level, I think it was the most interesting environment I've seen since '08. It's been pretty boring since then. So I think that there was a lot to do. In terms of managing the team, I think that was probably more challenging than the portfolio. You'd think on an island with severe weather risks, we would have been through this before, but we really didn't. I think that the operational aspects of capital calls and whatnot, that was actually harder.
So in thinking about the portfolios that portfolios today, and given the current market environment, are there any strategies that you mentioned or assets that you've traditionally have liked in the past that you're avoiding today, just given perhaps overvaluation we were talking about a little bit earlier, where things have run up quite significantly? So things that you might have relied upon in the past and really liked in the past as a more of a strategic position in your portfolios, are there any things that have just changed because of this and you're just looking to avoid now?
Maybe the opposite. I'll point to two. And I tend to not be super fatty, like bad, not calories, but like I tend to not like things that everybody else is super into. So like on the private equity side, I think I kind of, not to pick on them, but for years you've heard people saying they showed that graph, like here's how much money we got from improvement in the business and operational, and here's how much we made on refinancing the debt and leverage. And for some reason, they're always so great at the operational side, right? Well, let's see it now. I'm very excited to see now how great you're going to be on that side. So I think that's something I really want to see play out, especially because hedge funds, private equity, venture, they're all seem to be playing the same space now. You could almost just like lump them all together. When your hedge funds are doing venture capital, that's a very interesting environment, even if they're telling you early stage is uncorrelated. We'll see how that plays out. On the other side, is there anything I liked but didn't? So I think it's the opposite. There's stuff that I haven't liked for about 10 years that I think might become interesting in certain circumstances. So you mentioned commodities. I'm not a big fan of a long only static commodities allocation. But certain types of commodities, if I am right on this inflation story, could become more interesting. And so I don't know that I'd ever have a target allocation to it, but tactically, I think that becomes more interesting.
Yeah. So you've now mentioned inflation a few times, so we've got to now pin you down on it. So what are you doing to try to capitalize on your view on inflation, and what is your view? Because you threw out the T word, the transitory, and you kind of criticized, what is the definition of it? So what is your view on inflation, and what is interesting to you to try to capitalize on that view today?
Yeah, I don't think it's transitory. I do think it's a little bit longer lasting. I don't have a ton of faith in the Fed to really rein it in. I think last week on CNBC, they'd asked me, well, what do you think about break-even rates? I don't really care that much about break-even night rates. And that got cut out, thankfully, because I don't want a lot of backlash on that. But I mean, those are sort of being manipulated when you think about how much buying is going on in the tips market by non-financial
by the
players.
Fed.
Yeah,
by the Fed themselves. They own almost a quarter of the market already, right?
Yeah. So that I don't really pay attention to. And on the portfolio side, as you mentioned earlier, why do I care? I care because I care about the real returns we're going to get out of this portfolio. So what do you do? Because So there's a lot of arguments like, oh, equities are a hedge against inflation. Okay, some. So you could make tilts around the portfolio there. You could also look to be a little bit more country specific. Like maybe you're more interested in the UK than you are in the US for the breakdown of, kind of what's in from a beta level, from what's in their index kind of perspective. You could look at your real asset portfolio, but I think that real asset comment kind of annoys me sometimes because not everything in there is a really great hedge against inflation. I mean, not all assets there have a great beta there, right? And so I think that's the tricky part for me. I don't want to make a huge market call right now, and I don't want to take. So a couple of years ago, and I'll back up, I was thinking more about our real asset portfolio being more heavily equity related, and at the time I was thinking of it, that would not have turned out well. So I'm trying to be super careful about it. But we were also looking at hedges. And 2 years ago we thought of, or I guess more like 18 months ago, it may have made a little more sense. Now it's we'll see what happens there. But we're underweight on our real asset portfolio, so trying to find a way to get that up to speed quickly, and it may have to be through synthetics, which isn't super ideal. But like I said earlier, I just can't keep rebalancing into stuff that I know is going to get hammered if that's the case.
So what do you put in the real asset bucket? We mentioned briefly commodities. You said you don't like tips. Those are usually the top two things I hear, especially from clients these days. And they don't understand why we think inflation's not really transitory, or it's likely not to be, and we don't like tips. But it's valuation. I agree. That's why I agree wholeheartedly. It's the first thing I troll out is, here's the Fed's footprint since March of 2020, right, in the tips market. So what other things belong in that bucket? You briefly mentioned equities. What kind of exposures do you think about there?
Well, so I mean, here's the beautiful thing about how Hawaii works, because it's supposed to be driven off whatever that risk is in that portfolio. It can beat almost anything. So you can have private credit type stuff in there with like a real asset bent in it. You can have infrastructure investments, natural resources. You can have equities. You can have tips. And then I think you have tactical commodities as an option. I don't think you have a target to it, but as a potential option in there. And then I actually separate that a little bit from our real estate portfolio core and value add, mostly because there's not a lot that can really be done quickly there unless it's on the public side, right? But those are also potential parts of it. But a lot of these were underweight significantly, and we need to get into the market, which is why I'm more interested in the moment at some type of synthetic exposure.
Okay. So you also mentioned that you don't like to chase the fads. I won't put you on the spot and say what are the largest fads in there, but as you think about the future and you think about the way markets are moving, I hear this phrase of democratizing finance, and that seems to be a very common phrase when something new is introduced there. What do you see as kind of new burgeoning areas of the market that interest you, whether or not it's appropriate for the pension system or not?
Yeah. It feels like you're kind of asking me about crypto.
Not at all. Sam's the crypto guy in the firm, so that's not me. Yeah.
I don't think democratizing finance is a fad. I do think I'm so curious to see what happens in like the next 10 years. I do think there'll be probably I used to work actually in payments M&A, and I should have stuck with it. It would have been a very lucrative career, I guess. So I'm really curious to see what happens there, and digital currencies, and what does that mean for a fixed income if there's central bank currencies, and like all of that's very interesting. And I'd love to hear more. I have some idea of what you would say about it. Love to hear more about it sometime. On the blockchain side, I don't think that's a fad necessarily either. That doesn't mean I think it's something that at this moment we should be invested in. For one, I don't know that it's aligned with some of the ESG principles that our board is trying to align themselves with. I know I said I didn't want to go there, but let's go there for a second. And then I don't have blockchain or Bitcoin in the fund for the same reason I don't have a long only gold allocation. To me, it is essentially digital gold. And so if I wanted that, then fine. But tactically, I've said that that's a different story, but we're also kidding ourselves if we don't think that we have that somewhere in our portfolio, right? Like it's there. The play is certainly there. So I actually think on the fad side, a lot of them are structures and investment products that were. So I always say, like, if something was designed by the allocator in terms of a structure, it's probably not the most optimal way to go, right? Because if there was an optimal way to go, they would have sold it to us. So I'm interested to see how some of these like super long-lived funds are going to turn out, for example.
Yeah. Well, I think that's a big thing, and I wasn't leading you down the path of crypto, just so you know that. But also, you wouldn't be the first guest that broke their own rules. We've had a few of those recently. We don't want to talk about this, and they bring it up. So you're in good company there. But let's go back to kind of one more thought on that as well. And the democratization, that phrase is thrown around a lot with the crypto world, but also in the prevalence of retail.
Yeah.
And we've seen the resurgence of the retail trader. A lot of this has been attributed to commissions being lower, accessibility, fractional shares. There's an ETF for everything out there. How has that changed about you thinking about market structure? Does that play any part about you as an allocator, or is it something that you just say, hey, this is a fad, they come and go, retail will get bored at some other time? Does it change the way you think about, kind of how to allocate capital as well?
Probably more so if I had outright short positions. I actually think, I don't know that this is answering your question, but I think it might cull the marketplace. I think I don't think it was ever easy to make money, but I think it's gotten substantially harder. And I don't think people are factoring that in because I should say PMs, because I don't think that they think that's sustainable. But I don't think that's the case. I mean, technically I'm a millennial, and so I can kind of relate to some of those things. And I think that this euphoria is here to stay, especially if we keep getting, quote unquote, helicopter money. We've seen where that goes. That goes into these equity flows, and it's going back into the market. And we haven't seen any indication that that's going to stop, especially if I think like the September jobs number might be pretty, or August in September might be pretty bad. And if that's the case, and we keep getting these, then that won't stop. And so those flows will keep going into the market. So I don't know if it is a fad. I think it's going to be a little bit longer lived than everybody kind of thinks. My concern is more on the regulatory side. What is this administration going to do if this does go south? And how is that all going to pan out? But I do think that there'll be some people that just say, I can't play in this game. It doesn't make sense anymore. The fundamentals aren't being traded on. And we've heard that for a really long time. And my response is, yeah, that's frustrating. I went to Chicago. I believe in efficient markets, but yeah, get over it. That sucks. So someone's going to take your lunch, find a way to make it work.
Yeah, no, definitely. You forgot the other thing that people have done with those checks, and it's go to Hawaii and inundated your island over there as well. So, but it's good to see business coming back as well. Elizabeth, we're running out of time here, and we got to get to Sam's favorite part of the show. But before we do, can you tell our listeners out there how they can learn more about what you do, the work you put out there, any way to access your current thinking?
Yeah, that's a good question. I try to stay off social media for the most part, but I do have a LinkedIn profile, Elizabeth T. Burton. And then occasionally I am on podcasts and on CNBC. But I'm always willing to talk to people. So you can shoot me a note. I believe if you want to take the time to go to the website and look at my email address, you may do so. But yeah, I'm always open to chatting with people, particularly if you disagree with me.
Yeah. Well, there's no shortage of that. I know we've had some good debates in your offices, so I look forward to the next one as well. So thanks for taking the time. But as I said, we got to jump into Sam's favorite part of the show before you leave. So Sam, take it away.
All right, Elizabeth. And that favorite part of the show is called Sherman Says. It's where I will offer a series of alternating prompts between you and Jeff to elicit the top of mind response. As we said in the past, we try to keep it to one word answers, but that often fails. So, fire away, on your top of mind response. But I'm going to start off with Jeff first with boosters.
I don't know. I don't know if they're going to be necessary or what, but I'll give you an anecdote. I was at dinner a couple of weeks ago and sitting at a table, and I ordered a booster seat for myself because the seat was so low. My colleagues can do this. This was a business dinner too. We were out somewhere, and it was so low. And the waitress actually said, "We do have them." So it wasn't like the kids booster; it was another like cushion we put down. So the first thing I thought of was that booster that I used recently. So I'm not ashamed of it. It's what I needed. I could sit at the table. I felt like a child prior to that. So
Yeah.
that
You're not a very
well
short
taken.
guy either, so I can
No,
imagine.
and the other person with me was, about 6 foot tall. I'm a few inches taller than that, but and he was just sagging it too. So after seeing me do it, he ordered one as well. So I just thought maybe this restaurant should also consider maybe raising the chair. It was like a couch in a corner as well. But I did see John Cena at dinner as well. So if for our wrestling fans out there. So, Elizabeth seems like she seemed happy at that. So there you go. Yeah.
Yeah, he's got a couple new using Fast and Furious 9, I think, recently. I haven't caught that yet, but I plan to. So, but anyway, that gives a new life to the term low riding.
Yeah. And so that was not a one-word response. So feel free to criticize me.
So Elizabeth, he set the tone there. So we'll pass it back to you with rental cars.
Money. I had to explain this. We bought a third car in March because it was cheaper to buy one for 3 months than rent it out. And we sold it for a 25% premium recently, but we were also able to Turo it for $350 a day. It's a 2014 Ford Fiesta.
So it's a Ford party car, right? The Fiesta, right?
That's right.
Yeah.
It was
do you talk about
car.
market inefficiencies? You exploited one there. Yes.
Yep. It was pretty
we've
cool.
all heard the horror stories too, where it's cheaper to rent out U-Hauls instead of trying to find a rental car. So taking one of those U-Haul trucks out around the island must have been a unique perspective.
Yeah,
I'll bring this
still.
Yeah. Bring this one back to Sherman with crude oil.
It's going up eventually again. It's had a rough patch here, but I think we're going to see triple-digit oil again in the next year or so. So I just think once the economy's open back up, I think that the supply side can't keep up with the demand.
And it's a good segue to Elizabeth's next one. Second wave of COVID shutdowns.
I mean, all I can think of saying is like, ugh. I can't. Oh my gosh. It's just, I mean, I guess we saw it coming. It's just unreal. It's just like when you said that, like my whole body just immediately tensed up in stress. So thank you very much. I'm going to send you the bill for my therapist, but yeah. Hawaii may be re-shutting down here again too. So we'll see what happens. I certainly hope not. It's been very devastating.
Absolutely.
Yeah, well, every good allocator needs a very good therapist. So,
all right, bring it back to you, Sherm, with small businesses.
Backbone. It's the backbone of our economy.
All right, Elizabeth with crypto riches.
On the bandwagon. I know that's 3 words.
That works. It's Sherman's first response. So anything there wins. Back to you, Sherm, with data privacy. Important.
And that's what I don't understand about the newer generation giving away all your data for free.
Yeah.
That Gmail isn't free. You're getting pilfered and they're stealing it. So maybe we'll go back to having that as a priority again.
Right. I hope so. And then trend following to you, Elizabeth.
I one word answer on that. Overpriced. I mean, I can only think about it in my portfolio context, and to me, it's pricey when you can. It's getting pricey for what it is, but.
All right, and then we're moving into the final round here. What Sherman says. So Sherman, hard Mountain Dew.
Oh, is that the thing I sent through this morning? Like the new booze? Yeah, I'm in.
Elizabeth
I'm
saw it
totally
too.
in. Elizabeth seems stoked, but I love Mountain Dew. Love Mountain Dew, the zero sugar. Love all permutations. Love the America version. You know, the one that's red, white, and blue that has on there. Can't wait to try it. Oh, so
Yeah.
she's got her phone out. Yeah.
I texted it to everybody this morning, but isn't it basically like Four Loko or Red Bull vodka?
Right, exactly. Right. So you just got to be careful, you know, don't have 30 of them. But yes, it's kind of there again. And I used to originally, when the seltzer things came out, I called them Four Locos because that's what I thought they really were too. But this is going to be pure caffeine and everything. So it's funny you said that because I sent that out to my whole team this morning as well. So,
It
at
could
least
be
we're
a
on the
good-
same page there.
I'm gonna try it. I can't wait.
Yeah, it could be.
Yeah,
a
it's
good
not until
beverage.
2022 though. So COVID better not take that from us.
Yeah, right. Well, maybe we should put orders in now before they're $25 a can.
Yeah. Well, you can always get them at the Sherman Trading Post, you know, when they
Yeah.
become available there. So
That's right. That's right. It'll be part of the supply. There was toilet paper and eggs for a while there at the trading
Okay.
post. So
all right. And then the last one for the show goes to you, Elizabeth, with vacation destination.
Alaska.
The exact opposite almost of where you are.
Yeah.
I was gonna say, so it makes
it's
sense.
funny how that's usually what people do. By the way, I did go there 2 months ago. Gorgeous, awesome time, beautiful place, first time ever, and it was awesome. It totally delivered way above expectations. So
Wow. Good to hear.
yeah.
I'm gonna try to go there
yeah,
for
so
Mm.
yeah. Well, anyway, thank you so much. As you see, it's a lot harder to do, as Sherman says, when you're on the spot. It seems a lot easier when you listen to other people do it. So
I failed.
you did quite well. I set the bad tone. So thanks again for your time today, Elizabeth. It's great to see you again. Thanks for participating. As I mentioned earlier, you can catch us on the YouTube channel. It's youtube.com/DoubleLine Capital, all one word there. You can also catch Sam on his other podcast too, Monday Morning Minutes. He's a podcast guru these days. He does that with Jeff Mayberry. Also on the YouTube channel is Channel 11, which is hosted by portfolio manager Ken Shinoda. So this is our plug for all of our information we're putting out in this digital world today. And also you can catch us on Spotify, Stitcher, SoundCloud, Google, Apple, a bunch of other things I don't know about. And also don't forget to follow us on the Twitter. We have that. It's Sherman Show Pod, all one word, on there. And you can see some insights here as well as clips from today's show. So thanks again, Elizabeth. This is Elizabeth Burton. She is the Chief Investment Officer of the Employee Retirement System of the state of Hawaii, as I call it, HIERS. You know, is that how you say the acronym?
It is HIERS. You could just drop the I and call it HERS, though. I wouldn't be
Yep.
opposed.
Hey, you know, no problem. We can do that. It's yours and hers. So absolutely. But thanks again for the time, Elizabeth. We really enjoyed it. Take care.
Thank you.